Nike stock is continuing to make new lows. PayPal has fallen 23% after reporting earnings. Hims is down roughly 50% from its recent highs. Cathie Wood gave Tesla a new $2,600 price target, and China announced a breakthrough in chip technology that could rival ASML. There's a lot of news that I want to cover in today's video, so let's just get right into it. And let's start off by discussing Nike stock, which is now down 62% from its all-time highs. And as I said, it's continuing to make new lows. And I went through Nike's most recent earnings report to see why the market is being so bearish towards this business. So I want to share the highlights that I found. And here we can see that Nike's third quarter fiscal year 2025 revenues were $11.3 billion, down 9% year over year. Nike direct revenues were $4.7 billion, down 12%. Wholesale revenues were $6.2 billion, down 7%, and Nike's gross margin declined by 3.3%, down to 41.5%. The CEO did say, however, that the progress we made against the Win Now strategic priorities we committed to 90 days ago reinforces my confidence that we are on the right path. So right away, this does not look like a strong quarter for Nike. Its revenues, gross profits, operating income, earnings, and even its margins are all declining. And that's not a very good thing to see. So let's continue on. This next screenshot shows us Nike's revenue from different areas of the world. And we can see that its North American revenue is down 4%, Europe, Middle East, and Africa revenue is down 10%, Greater China revenue is down 17%, and Asia Pacific and Latin America revenue is down 11%. Nike's total brand revenue is down 9%, and Converse revenue is down 18% year over year. And for Nike's total business, revenue did decline by that 9%. So it seems like Nike is losing revenue in every area of the world, and it's losing the most amount of sales over in China with that 17% decline year over year. In terms of Nike's outlook, here they say, we expect Q4 revenues to be down in the mid-teens range, albeit at the low end. We expect Q4's gross margins to be down approximately 4 to 5%. We have included the estimated impacts from newly implemented tariffs on imports from China and Mexico. So Nike did factor in the potential of tariffs on China and Mexico into this guidance, but they are expecting revenues to continue declining significantly and their margins to drop by 4 to 5% in the next quarter. So Nike is seeing some serious headwinds to the business, and it looks like every metric is declining. Revenues and profitability is all going down. Let's quickly head back over to Stock Unlock to take a look at some of Nike's different KPIs. And we're taking a look at the North American revenue here, and we can see that it has been declining since about the second quarter of 2023, and it's now down about 10% in total. Nike's Europe, Middle East, and Africa revenue has also been declining since about the third quarter of 2023 and is down roughly 10% from its all-time highs. Nike's China revenue has been declining since the second quarter of 2021, and it's down about 20% from its all-time highs, and now it looks like it is continuing to decline at a faster rate. And lastly, let's take a look at Nike's Converse revenue, and it is continuing to drop quite dramatically. It looks like it peaked here in the first quarter of 2023 at about $2.43 billion, and it has continued to decline significantly, and it's now down about 20 to 30% from the all-time highs. So it seems like Nike's different businesses are losing sales around the world. And it also seems like in some areas, the revenue declines are accelerating. What's also worrying to me as someone who is not invested in Nike's business and someone just looking from the outside is that Nike is seeing increased competition from competitors like On and Lululemon. On has been absolutely killing it as well. From their most recent earnings report, this says, On delivers strong full year 2024 results, exceeding its latest outlook across all metrics. Net sales reflected a full year growth rate of 29.4% on a reported basis and 33.2% on a constant currency basis. On achieves a gross profit margin of 60.6%, which is significantly higher than Nike's as well. In the fourth quarter, On's net sales increased by 35.7%. The significant brand momentum drove traffic to On's e-commerce channel and global retail stores, resulting in a record high direct-to-consumer share of 48.8% of net sales in the fourth quarter. On achieved a record-breaking gross profit margin of 62.1% in the fourth quarter as well. For the full year of 2025, On is expecting to achieve a constant currency growth rate of at least 27%. So this is one of Nike's new competitors that is taking market share and growing extremely quickly. They grew revenue by nearly 30%, Their profit margins are hitting an all-time high at the same time as Nike's are declining, and it looks like for the full year of 2025, they're expecting to grow by roughly 30% once again. Lululemon is another competitor to Nike that has been taking market share. For the year of 2024, Lulu saw net revenue increase by 9%. Its America's net revenue increased by 2%, its China mainland net revenue increased by 39%, and then the rest of the world revenue increased by 27%. Down here, we can also see that Lululemon's gross profit was $1.4 billion, or 58.5% of net revenue. And once again, this gross profit margin is higher than Nike's. So Lululemon is growing strong in China, while Nike's sales are declining significantly over there. This means that Nike's loss of sales in China is a Nike-specific issue, as its competitors are continuing to grow strong. If we head back over to Stock Unlock, we can also see that Nike's price to earnings ratio is sitting at 22 right now, and Lululemon is actually trading for a lower PE, and it is the business that is growing faster. And in general, I do not think that Nike is looking overly cheap here. The stock was just very expensive historically, and it's now seeing its business decline. And a 22 price to earnings ratio for declining growth to every metric, falling margins, and losing market share does not seem like an appealing price to me. I simply think that there are much better stocks in the market right now. I also do not invest in the apparel industry because I don't know what brands consumers are going to want to be wearing 10 years out into the future. Like, I would have never predicted that Nike would be losing market share to newer brands that are popping up internationally. So the fact that Nike is actually losing market share and quite dramatically is surprising to me, and it just shows you that I don't have an edge in this industry. And I don't know what consumers are going to be buying in the future or what brands they're going to want. So for me personally, I think that this industry is just too unpredictable. And if a business is unpredictable, then I can't invest in it. So that's the reason I'm not buying Nike stock or Lululemon or On or any of these businesses in general. And also, even if I were to be investing in this industry, Nike is not the stock that I would be choosing because I think that it is still expensive for what it is. And one of its competitors that is successfully taking market share and growing faster is selling for a lower price. So if I had to, I would be buying Lulu over Nike personally. And that's kind of my thoughts on the stock today and the recent news with it. All right, now let's move on and talk about PayPal. PayPal stock is down 77% from its all-time highs. And just like with Nike, I went through PayPal's most recent earnings report and I took some screenshots of the highlights that I want to share with you. Here we can see that in the fourth quarter, PayPal saw revenues grow by 4% to $8.4 billion. Transaction margin dollars also increased by 7%. However, GAAP operating income declined by 17%, and its GAAP operating margin contracted by 4.31% down to 17.2%. PayPal's GAAP EPS also decreased by 15% to $1.11. For the full year of 2024, PayPal saw its revenues grow by 7%, transaction margin dollars grow by 7%, and GAAP operating income increased by 6%. So PayPal seems like it is growing its top line, and revenues did grow by 4% in the most recent quarter. But in the fourth quarter, its operating income and earnings per share did decline, and its overall profit margins did decline as well. Now, the next screenshot shows us the total payment volume mix across PayPal's payments platform. We can see that branded checkout increased by 6% year over year. PSP, or unbranded card processing, which is PayPal's Braintree, increased by only 2% though. And this is interesting to me because last year in the fourth quarter, it increased by 29% on a year over year basis. So this business right here, the PSP business, is seeing massive deceleration in total payment volume. Venmo total payment volume increased by 10%, P2P excluding Venmo increased by 6%, other merchant services increased by 27%, and eBay declined by 1%. And in general, total payment volume increased by 7% in the fourth quarter, and for the full year, it increased by 10%. PayPal's PSP total payment volume, specifically tied to its unbranded card processing businesses like Braintree, decelerated significantly in this quarter due to a strategic shift under the new CEO towards prioritizing profitable growth over raw volume expansion. As we can see right here, the PSP volume growth slowed to just 2% year over year versus 29% last year. The sharp drop stems from PayPal's price to value strategy, where the company deliberately adjusted pricing and renegotiated contracts with large merchants to focus on higher margin transactions rather than chasing low margin volume. Management has emphasized enhancing profitability in Braintree, which processes payments for other firms without PayPal's branding. This led to a trade-off, slower volume growth, but better margins. The CFO also noted on the Q4 earnings call that this dynamic, including volatility from larger merchant renegotiations, is expected to persist into 2025, further impacting volume as they work through existing agreements and try to expand the overall profit margins of the business. And this strategy has been working, by the way. PayPal's gross and operating margins have been improving over the past few quarters due to this shift in the strategy. And personally, I like that the management is focusing on profitable growth, as this is what creates shareholder value. As I have said on my channel before, revenue growth is not the holy grail of investing, and growing revenue doesn't mean that you will create shareholder value. Shareholder value is created through the profits of the business growing. So I do like to see that the management is prioritizing and emphasizing profitable growth and not just revenue growth. PayPal also gave us their outlook for 2025. And here they are expecting earnings per share growth of 6 to 10% in 2025. They're also expecting $6 to $7 billion in free cash flow and $6 billion in buybacks. So almost all of PayPal's free cash flow is projected to go to buybacks in the year of 2025. Now, if we head back over to Stock Unlock, we can see that PayPal is currently worth about $70.5 billion in the stock market, which means that it is trading for about 10 times 2025's projected free cash flow of about $6 to $7 billion. This means that PayPal is trading for roughly 10 times free cash flows, which is a 10% free cash flow yield on the cost of the business today. And the fact that PayPal stock is offering a 10% free cash flow yield and the business is still growing its revenues and overall profitability, albeit it's not growing very quickly, but it is still growing, leads me to believe that this stock is looking cheap in the market today. For example, PayPal could return all of its free cash flow to its shareholders in the form of buybacks, which is actually what the company is projecting to do in the year of 2025 anyways. And based on that free cash flow, it could return roughly 10% to its shareholders relative to the price of the stock today. So just on the free cash flow that the business can generate, it can deliver a 10% return to its shareholders through reducing the share count. So I do see why investors are buying this one and why the market thinks that this one is extremely cheap. I also did a very quick DCF calculation on PayPal, and I said that it is going to grow its free cash flow by 4% annually over the next 5 years, buy back roughly 5% of its shares annually, and trade for 15 times free cash flows. And if PayPal can hit these metrics right here, then the fair value of the stock is $96 per share, and the stock could compound by roughly 17% per year. And I do think that these are pretty pessimistic metrics for PayPal to actually achieve. So then the question is, why am I not buying PayPal stock? And personally, I just don't have the conviction in this business to know if it is going to continue growing over the next 5 years, because I think that this business is seeing some headwinds, and overall, I'm just not that optimistic on it. I've also seen a lot of payment processing companies pop up over the years, like Four, for example, and Four is growing significantly quicker than PayPal, and it's not trading for that much of a higher price multiple. So PayPal seems to be growing a lot slower than its competitors, and that leads me to believe that it's not a truly high quality business. And due to PayPal not being what I consider a high quality business, I'm just not that interested in purchasing its stock. I do see why people think that it is cheap, but I just don't have that conviction. I don't think that it's high quality, and I would have to remove something from my portfolio to buy this one, because I don't want to buy every stock that seems cheap in the market. I really like to be a concentrated and focused investor. So again, I would have to remove something from my portfolio to buy PayPal, and I like everything in my portfolio better than PayPal, so I'm not going to buy this one. And that's my thoughts on PayPal stock. All right, now let's move on to HIMS stock, which is now down 47% from its recent peak, which was basically a month ago. And a recent research report came out from Morgan Stanley on HIMS that I thought was interesting and I want to share with you. So this says, the Hims and Hers platform is seeing strong momentum, with app downloads up 47% year over year and web traffic up 18% year over year in the month of February. Monthly app downloads are now at 250,000, with cumulative app downloads nearing 5 million. Growth in February was driven by Hers downloads, with the proportion of total downloads surpassing 44% of total downloads in the past month, up from 21% in the year ago period. Hers saw year-over-year growth of 212% in contrast to Hims at 4%. So hers downloads are absolutely exploding and are up 212% year over year, whereas Hims is seeming like it is slowing down and only at 4% year over year. And the Hers brands is seeming to attract a lot of new customers and continue to grow very strong. And overall, Hims and Hers platform downloads are up 47% year over year. Hims also released a brand new investor presentation in February, and I went through it and I took some screenshots that I want to share. So in the screenshot, we can see all of the different verticals that Hims has launched by year and the company's revenue growth. And in the year of 2024, we can see that Hims did grow its revenue by 69%. We can also see that in the year of 2024, Hims had verticals of weight loss, mental health, Hers dermatology, Hims dermatology, and sexual health. In 2025, Hims is planning on continuing to launch new verticals to existing subscribers and to attract new subscribers. Then they also say here that Hims dermatology subscribers are up 55% year over year, and Hers dermatology subscribers are up over 100%. So they've more than doubled. Oral weight loss also reached $100 million in revenue within 7 months, and GLPs are less than 20% of the company's revenue, but did see a lot of growth in the year of 2024. This next slide shows us Hims market share and its competitor market share. So we can clearly see that Hims' share of observed total customers in the telehealth space is at 47.5%, and it looks like it is continuing to grow. Hims' share of total observed sales is also growing and sitting at 47.3% now. So they have almost half of the new customers and almost half of the total telehealth sales in the United States. However, one of Hims' main competitors is Ro, and they are gaining market share and sales. Hims is still a much larger company and is outperforming, but Ro is also the other company that is growing market share and sales. So I am keeping an eye on this, but I'm not necessarily concerned about it just yet. Hims also gave us their outlook for the first quarter of 2025 and the full year of 2025. And we can see that for the first quarter, they are expecting revenue of about $530 million, which is year over year growth of about 90%. For the full year of 2025, they're expecting about $2.35 billion in revenue, which is year over year growth of roughly 60%. So Hims is expecting another very strong year in 2025. Hims is also expecting adjusted EBITDA to come in around $300 million and an adjusted EBITDA margin of 12 to 13%. Now, why this is important is because historically, Hims' operating cash flow margin has always been higher than its EBITDA margin. And in the trailing 12 months, its operating cash flow margin is sitting at 17% versus its EBITDA margin of 6%. So if Hims is projecting its EBITDA margin to grow to 12 to 13%, then that theoretically should mean that its operating cash flow margin should continue to grow. And if it replicates history, then this could mean that Hims' operating cash flow margin could be around 25 to 30% in the year of 2025. And in general, it seems like Hims is expecting its profit margins to continue expanding throughout the remainder of this year. Personally, I think Hims could easily achieve a 25% free cash flow margin if the company wanted to. But currently, the company is investing a lot of money into growth. And to be clear, I think that they should continue doing so. But the profit potential of this business is very, very high, in my opinion. Now, another thing that I want to show you is Hims' operating cash flow versus its stock-based compensation. So back here in the first quarter of 2022, we can see that Hims had operating cash flow of negative $40 million and stock-based compensation of about $42 million. And today, in the most recent year, Hims has produced operating cash flow of $251 million and did stock-based compensation of roughly $92 million. And you can clearly see that Hims' operating cash flow is growing at a significantly faster rate than its stock-based compensation. And I think that this will continue. And as a result, Hims' stock-based compensation should continue to make up a smaller and smaller amount of overall operating and free cash flow. And therefore, stock-based compensation should continue to become less relevant over time. Now, I also did a reverse DCF on Hims to see what the market is currently pricing into the stock for it to achieve a 10% compounded annual growth rate. And here we can see that the market is currently expecting Hims to grow its free cash flow by roughly 13% annually, dilute by about 2% annually, and trade for a 22 price to free cash flow. Now, I did also enter Hims' trailing 12 months free cash flow to be about $350 million, which I think is the profit potential of this business. So if Hims can continue to grow its profit potential by 13% annually and trade for a 22 price to free cash flow, then the stock could produce a compounded annual growth rate of 10%. Then I did another DCF with 20% annual free cash flow growth and a 25 price to free cash flow, which I think is still pretty pessimistic for this business. Because again, they are projecting over 60% growth in 2025, and a 25 price multiple for a high margin business that's growing 60% is pretty low. But if HIMS can continue to grow at 20% and maintain a 25 price to free cash flow, then the stock could compound at 20% annually over the next 5 years, and its fair value would be about $55 per share. This is a business that has gone through a lot of drama though, but it is still projecting strong growth this year, and it's growing insanely well. So I'm going to continue hanging on to my shares as I am happy with my current allocation to the stock, and I don't really see any reason to sell it. So that is my opinion on HIMS stock today, and that is what I am doing with my position and kind of what I think the fair value of the stock is. All right, now the next piece of news that I want to talk about is actually a clip of Cathie Wood discussing Tesla stock and what her future expectations for the business are. So I'm going to play that clip really quickly, and then we will discuss it afterwards.
Elon has announced that Tesla will launch its robotaxi service commercially in Austin, Texas in June. That is when analysts are going to have to put into their models what a robotaxi service is. And it's a software as a service model. Right. Very high margin, 80% plus for the platform companies, whereas the electric vehicle is 15, 20, 25% gross margin. So we think that robo-taxis will account for 90% of the value of the company in 5 years. And we're on record saying we believe in 5 years the stock will hit $2,600. And that's not even including humanoid robots, which are now moving into the Tesla ecosystem much faster than even we expected. So more than a tenfold increase just from robotaxis. So.
All right, my notes from that clip are that Tesla is going to be launching its robotaxis in Austin this year, and Cathie Wood believes that the margins on this business and on the robotaxi revenue is going to be over 80%. Its gross margins are going to be over 80%. Then she says that analysts are going to have to factor in the robotaxi revenue to their future expectations for Tesla's business, and she thinks that this is going to cause analysts to revise their expectations up massively. She also says that robotaxis will account for 90% of the company's value within the next 5 years, and the stock is going to be worth $2,600 by 2030, and this does not even include humanoid robots into the valuation at all. Now let's go over to Tesla's stock right here, and we can see that it is currently valued at $881 billion. So Cathie Wood is expecting Tesla to be worth around $9 trillion by 2030. And again, she said that 90% of the business valuation will be from robotaxis. So she is saying that robotaxis are going to be worth $8 trillion by 2030, or that Tesla is going to create $8 trillion in value from robotaxis over the next 5 years. Cathie is saying that she thinks robotaxis alone are going to be 4 times larger than Google's business today within the next 5 years, which is also funny because Waymo, which is owned by Google, is actually operating robotaxis in multiple cities across the United States right now. Google is actually ahead of Tesla in the robotaxi market right now. So why doesn't she think that Google is going to be a $10 trillion business over the next 5 years? So in general, I think that these projections are just absolutely wild, and I don't really know why people still have Cathie Wood going on their shows and paying attention to Cathie's opinions. So I did a quick discounted cash flow calculation on Tesla stock to see what the company would have to produce over the next 5 years to be worth $2,600 per share, which you can see right here. And this is the numbers. So Tesla would have to grow its operating cash flows by 70% annually and trade for a 40 price to operating cash flow to achieve a stock price of $2,600. This would also result in a compounded annual growth rate to the share price of about 56%, which is extremely high. But overall, she is expecting Tesla's operating cash flows to compound by 70% annually over the next 5 years. Now, if we scroll down, this means that Tesla would have to generate $210 billion in operating cash flow by the year 2030. And this is what the operating cash flow chart would look like. This would literally mean that Tesla would have to grow into the most profitable company in the world within the next 5 years. at the same time as they are competing against Google's Waymo, and the company is seeing headwinds in its existing business. So I simply think that this is not going to happen. This is out of the realm of reality. And I think that Cathie Wood is throwing out extremely high price targets to generate media noise and to basically get investors excited about Tesla stock. But if you think about this logically, I think that there's no way that Tesla is going to do this and become the most profitable company in the world and the most valuable company in the world by far over the next 5 years. Now, I also want to show you Tesla's revenue versus BYD, which is the Chinese electric vehicle and auto company. And here we can see that BYD's revenue has been growing significantly faster than Tesla's over the past few years. And BYD is actually about to pass Tesla in total revenue. I think that BYD is arguably outperforming Tesla and taking market share from Tesla, at least over the past few years. And I think that this chart is very clear that the company is doing that. Now, what's also interesting is if we take a look at the price to operating cash flow ratios of these businesses, we can see that Tesla is trading for 60 times operating cash flow, and BYD is only trading for 9 times operating cash flows. So BYD is trading for about 1/6 of the price, despite the business actually growing faster and seeming like it is having more momentum and taking market share from Tesla. Now, I also understand that people say that Tesla is more than an automotive company. And to be fair, Tesla's solar business has been growing extremely well. But I think that investors need to understand that Tesla is being valued as a high-growing, high-margin software company. So while Tesla may be more than an auto company in the future, you have to understand that the business is not being valued as an auto company today. It is currently pricing in a lot of future growth of high margins and basically becoming a software company. So if you are buying this stock today, you have to understand that you're already paying for a lot of the company's future success in the software industry and that high margin industry. Because again, this stock is not reflecting its current business. This stock is already pricing in a lot of future growth, and investors are already paying for a lot of future growth on this one. So I think that even after a 50% haircut to Tesla stock, it is still extremely overvalued, and I'm not interested in it in any way. And I think that the price targets that people are throwing out are just kind of insane. And I don't think that Tesla is going to become a $9 trillion business by 2030. So I wanted to share my thoughts on Tesla stock because it has been coming down a lot, and that's my thoughts on the business today. All right, now let's move on to the last piece of news that I want to talk about, which is an apparent China EUV breakthrough that is reportedly going to compete with ASML's lithography machines. This article says that China's LDP-based EUV systems can produce chips with 13.5 nanometers. Now, this doesn't directly compete with ASML's 5 nanometer technology, but it does still compete with ASML's overall business. And this next screenshot explains why. Due to US export restrictions, China has been unable to obtain ASML's EUV machines, forcing domestic chip makers to rely on deep ultraviolet lithography, which operates at 248 nanometers and 193 nanometer wavelengths. If China commercializes LDP-based EUV lithography by 2025 to 2026, could it bypass Western technology restrictions? The answer, possible, but significant hurdles remain. Mass production of LDP-based EUV machines could allow China to lessen its reliance on ASML and Western semiconductor suppliers. The reason this could impact ASML's business is because ASML produces about 20% of its sales from China, and it is projecting about 20% of its sales to come from China in 2025. So this could impact ASML's China sales in the short term if a Chinese company can offer better machines than ASML is allowed to sell to China. And long term, if China can continue improving this tech and getting it down to that 5 nanometer range, then it could attack ASML's moat, because right now, they're the only company in the world with this level of technology. Personally, I do not think that this is something for ASML investors to worry about right now, but it is something that I would pay attention to, because if China can continue to develop this technology, then again, it could attack ASML's moat over the long term. But with all that being said, that is going to wrap up today's video. And if you did enjoy this video, then please remember to leave a like on it and let me know what you think down in the comment section below. Also, if you would like to get more stock market related content like this and updates about the stock market, then please consider subscribing to my channel if you haven't already as well. As always, thank you all so much for tuning in. I truly do appreciate it, and I really hope to see you all again in my next one.